Most investors don't know if they're buying a decade-long bull or a 10-year trap. Today, I'll show you the real data, earnings, the economy, and big money flows. If you get this wrong, you could underperform cash and bonds for years. If you get it right, you ride the next big wave of wealth creation. Let's start with the only thing that matters long-term, real corporate earnings. This chart shows inflation-adjusted S&P 500 earnings from 1871 all the way to 2026. Real earnings climbed from about $10 in 1871 to over $230 today. Look at the recent years. 2022 peaked around 227.55, 2025 is at 216.11. So 2025 is lower than the 2022 peak, but both sit near record highs. Compare that with real crises, like 2000 and 2008, when earnings actually collapsed. Today, we're not seeing a cliff drop in profits, we're seeing a high plateau with mild cooling. So the earnings story is not apocalypse, it's still strong but no longer exploding. Next question, is the economy quietly breaking or just slowing down? The latest jobs report doesn't scream collapse. January added about 130,000 payrolls versus roughly 70,000 expected, and unemployment slipped to 4.3%. Here's U.S. real GDP growth over the last few years. Growth mostly stayed positive, roughly around 2% a year since 2022. That's not an amazing boom, but it's definitely not a deep multi-year recession. Now check the unemployment rate from the Federal Reserve's FRED database. Unemployment has been hovering between 3.5% and 4.5%. In real crises, like 2009 and during the 2020 COVID shock, unemployment spiked into the 10 to 14% range. So the economy looks more like slow growth with low joblessness, not a system in freefall. If earnings and the economy are okay, the real issue becomes, what are we paying? This is the Shiller CAPE ratio, price divided by 10 years of real average earnings. Historically, CAPE averages around 16 to 17. Below 10 has meant extreme fear. Above 25, we're in expensive territory. Right now, CAPE sits in the high 30s, near some of the richest levels ever. Flipped around, the S&P 500 earnings yield is only about 3.4%. Meanwhile, the U.S. 10-year Treasury pays roughly 4.18%. So we're in a rich bull market. Stocks can still win, but the margin of safety is thin. Finally, we follow the money. Are big investors quietly heading for the exits? This table from the Investment Company Institute tracks flows into funds and ETFs. For the week ending February 4th, mutual funds saw outflows of about $3.06 billion, but ETFs had net issuance of roughly $42.85 billion. Combined, long-term funds plus ETFs brought in almost $39.8 billion. So money isn't fleeing stocks. It's rotating from old mutual funds into cheaper ETFs. That looks like structural demand for equities, not the start of a mass liquidation. So, is this a bull market or a 10-year trap? Let's recap the data. 1. Real earnings are near record highs, even if they cooled slightly after 2022. 2. The economy is in slow but positive growth, with relatively low unemployment. 3. Valuations are rich, CAPE in the high 30s, earnings yield below bond yields. 4. Technicals show an intact uptrend, but price is stretched under 7,000 resistance. 5. Big money is still a net buyer of equities through ETFs, not rushing for the exits. My verdict? Over the next 5 to 10 years, I'm bullish but not blindly optimistic. I stay invested through broad, low-cost ETFs, and I expect volatility instead of a straight-line rally. If valuations ever reset closer to historical averages, that's when I'll turn aggressively bullish. If this gain-driven breakdown helped you, smash the like button so YouTube pushes this to more investors. Comment bull or bear below and tell me which chart changed your mind the most. Make sure you subscribe and turn on notifications so you don't miss the next deep dive.